A ceasefire between the U.S. and Iran is shifting the tone across global markets. Joining us now to break it all down is Michael Craig, Head of Asset Allocation at TD Asset Management. Michael, thanks for joining us.
My pleasure.
Right off, what's your view here?
Yeah, a few things. We're in obviously a materially better place today than we were a few days ago. We avoided a humanitarian catastrophe, which is being threatened by Trump. We're certainly at a worse place we were versus a month ago. And I think this truly is in the spirit of a ceasefire, a timeout, but really with no fundamental issues resolved other than just an agreement that we're going to continue to talk. But it's going to be challenging to see how things evolve from here in terms of each side walking away with something without, those demands I think are going to be quite difficult to work through. So certainly some relief in the markets, but I don't think that you can wave the all clear signal at this time.
Yeah, you wake up to that relief today, or even yesterday evening, sort of think, okay, well, now we've got this juice. In terms of what are we watching now? We've got 2 weeks, right? What are you watching?
You certainly look for violations of ceasefire. You'll want to see hostilities dial back in Lebanon, attacks on Gulf infrastructure, and really to see what happens with shipping through the Strait of Hormuz. I mean, I think the issue today is that Iran now has really seized control of that choke point, and that choke point has tremendous implications for global growth. And so if the end result is in the short term a toll booth, it's probably not the end of the world. I don't think that's an acceptable long-term asset for the Iranians to hold. And this is why I think we come back to this as both sides basically rearm and start to think about what the next phase looks like. But I think today this is certainly a better place. We're not going to have oil shortages, which we're coming in about, as I look at my watch, like literally in about 10 days, we're facing pretty severe oil shortages in many parts of the world. Always the poorest countries suffer the most, but you would have seen it in Europe and throughout Asia. And so that kind of worst case scenario is for now put on the side. But there's still a lot of work to do, and I think all sides kind of coming out of this weaker. Iran's been degraded for sure, and the U.S. has certainly burned, I think, a lot of its brand and credibility with allies through this conflict. The allies were not really kind of given a heads up or had bought into this, and then as it proceeded, they were expected to come and support. After a while, people start to get a bit tired with that kind of approach, and so I think these things are not going to heal anytime soon.
So we'll take this moment of relief. Of course, there's important things to watch as you laid out. What are the implications for the markets, for geopolitics? Yeah,
so I'm going to start short term and then long term. The short term is not nearly as interesting, but I think we need to talk about it because there's been a pretty euphoric move today. Look, positioning going into this last month was brutal for hedge fund type investors, real money investors. Tough month, but really, really bad for kind of the leverage community. And so going into last night, I think positioning was quite clean. And so that's why you have, as the tide comes back in, everyone's rushing in. And so you're seeing, in the North American markets, reasonable moves, 2-3%. But you start looking at other markets. Emerging is up 6%, Korea is up 10%, Europe is up 5%. European bonds are rallying 20 basis points, like big moves. And I think that just is more of a testament to just positioning had been cleaned out. I wouldn't look at the markets and say, oh, the markets are rallying, everything must be good. This is really a technical rally, in my opinion. Longer term, it's complicated. If you step back, the key geopolitical rivalry remains the U.S. and the Chinese. And neither side wants to go into that without allies. They need allies because they're so big that they can't go at it alone. And what do you have here? Well, in many ways, Europe has probably moved somewhat more in between those two orbits, totally irritated by this conflict. Certainly the global South will look at this and say, how much trust can we put into the U.S.? China comes out looking okay because they just basically played a role as a bit of a sideshow to this and didn't really get involved, which is typically the Chinese are very much focused on their interest in what they're trying to accomplish and not trying to solve problems in other parts of the world. And for Canada, I mean, we've been bullish Canada. I would say, having through this, I'm more bullish now because it's just more pressure on our country to deliver what the world needs. And it's not just getting commodities, it's getting commodities from trustworthy suppliers, and not just commodities. Like, it really starts to, we should be thinking about refining our goods. We should think about value-added processing, because when you look at the globe, it's a pretty attractive place to be sourcing that thing. So I think, and this is not a 1 month or 3 month view. This is a view I think that will if we're right, will persist through the remainder of my investment career, which hopefully is a long time. As it takes a long time for these things to build out. But I think that, we come out of this looking, oh my gosh, we have this opportunity, this phenomenal opportunity to be a force for good in the world, and consistent supply of energy and resources, critical minerals, et cetera. So from that perspective, I see a tremendous opportunity. It's just whether we can capitalize on it, and that is always where the risk lies.
In terms of asset allocation in the longer term, because in the short term we're worried about the soaring price of crude, what it can mean for inflation, what it can mean for interest rates, all very in-the-moment kind of things. I mean, we still have to worry about those things or think about those things. But when you think about capital allocation with what's happening and where we're headed, what are your thoughts?
Okay, so I can't say that we had any. If you asked me 3 months ago, would there be a war in Iran, I would probably said no. But if you asked me 3 months ago, are we going to have a challenge in the Middle East for the next 5 years, I'd say likely. Our view with capital allocation is that the world is far more complex today than it has been in our time. That the result of that is going to lead to much more volatile inflation and growth. So, much of our career we had this declining or disinflationary backdrop and growth ebbing and flowing. Now, I think growth is more volatile and inflation is more volatile. And that gets you to looking at portfolios, not just in terms of bonds and equities, which traditional balanced fund is, but is adding elements that perform in periods of excessive growth or excessive inflation. And that gets to a much more complex multi-asset portfolio. But the result of that is a return profile that is more comfortable for investors. And ultimately, the most important thing for us to do is to ensure that our investors know that we have their back and stay invested. Because when you sell in a moment of panic and then just 9 months later you decide to reinvest, generally those periods are when you see the highest returns in the market. And that is very hard. You almost, put another way, that is like adding years of work to your life to make up for not being invested in that short period of time, because that's when you see these big returns. So for us, it's allocating to commodities, allocating to certain private assets that are creating cash flow. So we're not, you don't want to. I don't advocate, speculating on the next big thing. It's just too complicated, and you need a lot of those bets because most of them go to zero. But actually looking at private investments that are creating cash flows today. Looking at other areas within the market where we can grab return that is uncorrelated to bonds and equities. And so that is where the efforts are. And when you have that approach, things like this occur, but you're prepared for it. Last month, stocks and bonds fell off. But we had other areas that worked. Commodities this year are up. Even after today's sell-off in commodities, they're still up 20+% this year. And that is the goal of it, is to make sure that you never want everything, you never want all of your investments working at the same time, and you certainly don't want them all not working at the same time. And that's the whole power of diversification.